Hello everyone, welcome back to GloryHouse Podcast. Today we're diving into an investment space that most investors may not be familiar with, but the estimated global market size is USD 2 trillion and growing. We're talking about royalties. The non-cyclical, uncorrelated qualities of royalties makes it a powerful tool for modern portfolio construction. Joining us today is Stephen Otter, head of Private Markets Royalties at Partners Group. Stephen pioneered Partners Group's royalty capabilities back in 2021, initially incubating the strategy within the founder's family office. Today, he leads a delegated team of 20 royalty-focused investment professionals at Partners Group, managing one of the most innovative multi-sector royalty strategies in the market. So welcome, Steve.
Thank you for having me.
So last time when I was interviewing Urs, he was like, I have my family office investments and I asked the team to design a strategy that never lose money for me. So royalty was part of the strategy. So maybe can you elaborating to our audience today about why you want to invest in royalties and why it's a good strategy?
Yeah, happy to do so. So as Urs mentioned, over 7 years ago now, they basically in the family office, which manages their own net worth of Freddie, Marcel and Urs, they look to have uncorrelated strategies which help to diversify and stabilize their traditional portfolios, which obviously have large public equity positions, large private market investments in traditional private markets, so private equity, credit, real estate and infrastructure. And so the family office was set up and tasked to scour the globe across all asset classes to find other asset classes which can help reduce down the volatility and basically focus on capital preservation and long-term growth upside. And so the family office started out in insurance finance, then moved into litigation finance. And then the strategy they asked me to build was a cross-sector royalty strategy, which was very interesting to me 7 years ago, having spent a decade doing energy royalties, is that nobody had ever attempted to do a cross-sector approach. Everybody had either done music or healthcare or energy. Nobody had ever had the foresight to take royalties as a standalone asset class and to wrap all of the sectors into it. So we've been doing the strategy now we're entering into our 7th year in an evergreen. Going back to Urs's comment about never lose money, in that time period we've only had 2 negative quarters, entering our 7th year, so very consistent returns. Even those negative quarters have been minus 0.4 and minus 0.1%. So the strategy at the outset was, we don't want you to be reliant on interest rates. We don't want you to be reliant on exits. We want you to focus on producing high quality assets and really underwrite the yield that comes back with them. And so the great thing about the strategy is we're not driven by market trends. Ultimately, we buy music that people consume on a day-to-day basis. We own royalties over healthcare products, which people continue to consume irrespective of what's happening in the S&P 500. We own royalties over gas wells, which continue to produce. So these uncorrelated revenue streams are a nice mix.
So I think most people probably familiar with the single sector royalties, right? If you have like music catalog, we see funds like that, or just mining streams. But how do you construct the portfolio for different sectors?
So as of today, we really focus on 3 big sectors. So sector number 1 is healthcare. And I should say in general, going back to Urs's comment about don't lose money, that has driven a lot of our strategy. So number 1, as I mentioned, not focused on interest rates, not focused on exits, underwrite the yield that comes back from the asset. The second part is it means we focus on producing assets. We're not taking development risk. So in all of our sectors, we're focusing on assets late in the life cycle, when in theory, the volatility is at its lowest possible, and it should be the easiest to project the revenue line going forward. So as of today, we focus on 3 sectors, as I said. Number 1, healthcare. So post FDA approved, best in class products selling in the healthcare space, where we receive a percentage of the revenue. So we're not funding the costs, we're not funding the R&D, we're not taking approval risk. We literally take between 1 to 10% of the revenue as and when the product is sold for the life of the IP. So that's sector number 1. Sector number 2, we do entertainment, which people assume is just music. It's much more than just music. We buy film and TV IP, we buy the music of film and TV, we look at book royalties, we look at theatre IP, we do royalties in sports, royalties in brands. And then last but not least, probably the least glamorous, but I would argue one of the most attractive yielding sectors that we invest in, we do the energy transition. So US natural gas, green metals and carbon. But the great part of the strategy is that We are not told that you have to do 5 music investments or 5 healthcare investments. We're told as the investment team to go and source the best relative value. And so if there are times where one of the sectors is in a bubble, which in the past music was a bit of a bubble, so we stopped investing. Right now we see the mining space in a bit of a bubble, so we've kind of paused to focus on mining. But we're deploying where we think we can generate the best returns while being cognizant of diversification. But we don't have strict guidelines. It's not you have to do X number here and Y number there. We go where we see the value.
Can you maybe talk us through like a real example? How do you, I guess, source a royalty deal, and how do you evaluate the cash flow, and how do you, I guess, make sure inflation is baked into a contract?
So on the sourcing side, we take a multi-approach to sourcing. So we have a long list of assets that we know and like, and we look to build the relationship with the existing owner, such that if they want to monetize, i.e. sell all of, or partially sell, or borrow against their royalties, they think of us when the time is right and they come and speak to us. We know all of the key advisors in each of the sectors that we invest in, such that if somebody is looking to sell a catalogue or a healthcare royalty, we're informed. We also invest in sectors that Partners Group invests in. So in healthcare, we have a big PE business. We invest in energy transition. We have a very big infrastructure business. So we see a lot of deal flow through the other asset classes at Partners Group. You'd be amazed how many LinkedIn messages I get a month, with probably about 20 of people trying to connect with me to sell a royalty, because the one thing that Partners Group has done very clever is to not put us within the credit asset class, not to put us in the private equity asset class, but to go into the market and say, we are launching royalties as an asset class, our first new asset class in 20 years, and have been very visible around that. So increasingly when there are royalties coming to market, we are contacted because of the branding that we have in the space. And then quite often we partner with some of the other investors, because in royalties, big assets are typically very big, anything up to $2 billion, which is large for a royalty, particularly because it's single asset concentration risk. And so you don't want to do all of that check size yourself. You want to partner and take down a more sizable chunk. And so we have partnered with some of the other single sector funds as well.
And yeah, a lot of our investors are looking for capital preservation. How resilient is the royalties cash flow in, say, a recession type of environment?
So we think the sectors that we invest in, and it's not just we think, I mean, the data has shown over the last 10 to 20 years, they're pretty resilient sectors, because ultimately, let's think about you personally, Cathy, whether your day job or your personal life is going well or badly, I would imagine you will still pay to listen to music. Maybe I'm wrong. If you have a specific healthcare treatment that you buy a product for, you are going to continue to buy that irrespective of what's happening in broader markets. Similarly, you will look to power your car, you will look to power the electricity in your house. So the sectors we invest in, we think are ones that people will continue to consume through periods of recession. And we're not taking bets on entire industries or entire companies. We are really cherry picking crown jewel assets, which we think have a moat around them. And so we see it as being very defensive. I would say the bigger risk we face is when the royalties we buy are typically long dated. So the strategy is not for short-term investors, it's for mid to long-term investors. But for instance, when you buy a music artist, they may be popular today, but who's to say they're popular in 50 years' time? Natural gas is an important commodity today, but will it be in 10 years? Difficult to say. A healthcare product has a competitive advantage today, but will it have that same positioning in 5, 10, 15 years? Very hard to say. So that's the biggest risk that we manage, and it's why our investments are long dated, but we try to get our clients' capital back within the first 5 to 7 years. And that's all on a cash yielding basis. It's not assuming exits in it. And then the duration after that, that is really kind of cherry on top, but we're not underwriting or needing it to protect our capital. So capital preservation is at the forefront of everything we do.
And we're talking about liquidity because you said it's a view as a buy and hold long-term asset, right? But the fund itself gives liquidity. So how do you structure the fund to provide liquidity to investors?
So if you think about royalties in general, there's 4 ways an investor can access it today. There are websites where you can go and buy the royalties directly yourself. So if you have clients who want to go and buy a music royalty, they can Google musicroyaltyexchange.com and you can actually go and buy a royalty directly if you want. So that's the first way. The second way is you can obviously invest into listed royalty vehicles, which makes sense, but equally you're introducing, just by being listed, you're bringing market volatility into the strategy. So we don't think that's the perfect match. There are closed-ended funds, but our view is in a closed-ended fund, you're restricted in terms of how many investments you can put in because you obviously have a duration. So you can't be as diversified as you'd want to be in our view. You also do need to sell your assets at some point. And how do we know today what the market will be like in 6 years for a sale? And so we think evergreens are the perfect match for royalties because it enables you to build a diversified portfolio of assets. It enables you to really underwrite the yield. And actually, it's very different from other asset classes which use evergreens, which don't generate any yield until there's an exit. Our assets are generating yields of north of 10%. So it generates a lot of liquidity by the nature of the investments. And so we have two different types of funds. We have a lower liquidity fund where it's all royalties. There's no liquidity sleeve. We only call capital when we have an investment to fund, pays out an attractive yield. It can take longer to redeem, so people have to be aware of that entering in. And then we have a higher liquidity version where 80% goes into royalties, and then the other 20% goes into cash, listed royalties and BSLs. So there is more liquidity and you can trade in and out easier, but it just means the returns are lower because of the cash drag.
Yeah. And I guess from a strategy perspective, do you buy royalties, lend against it, or you more create royalties? Where do you see opportunities?
So if I look back over the last 12 months, it's been about 40% has been us buying an existing royalty on a product. About 30 to 35% has been us lending against a royalty, which I can't stress how attractive that is, because it has less upside for sure, because you obviously don't benefit if it goes up more than you anticipated, but equally it can go down materially more than you'd have hoped, and your returns are still protected. And so half of what we have been doing in the entertainment space has been lending to artists directly, which I think is important because it means they continue to own their IP, which is their life's work. They have some monetization event, and we're secured against that royalty pool. And then the third thing we look to do is the creation of royalties. Now that takes longer because you have to find a counterparty who is open to taking royalty financing. It can take time to educate them. It can take time to get a board comfortable because it's not equity and it's not debt, and many people haven't done it before. And so that's been a smaller percentage, but going forward, we would like to see that continue to grow as an opportunity set. So in healthcare, the creation of royalties is expected to grow by 5x over the next 10 years. Some of the other sectors we look at, we see real growth potential there. So on a kind of 5 to 10 year outlook, we'd like to be equally a third across the three.
And is the secondary market opened up? Like if you were to sell a royalty, the transaction volume is picking up?
It is. I mean, we don't price the exits. So the returns we will talk about in our presentations, they assume not a single exit in 5 years, 10 years, 15 or 20 years. Obviously, we expect that not to be the case, but it's nice not to be waking up every morning thinking, oh, I need to sell an asset to generate the returns. We don't have that stress, which means we're in a very powerful position when it comes to monetizing the asset. We've now sold 3 royalties in the last 12 to 15 months, 2 of them north of 40%, 1 close to 25%, nearly double/triple what we underwrote. So we do have that potential. I think it depends on the sector. So if you're looking in healthcare, there's a very active secondary market. If you're looking at music, very active secondary market. Natural gas, active secondary market. Some of the other sectors which are a little bit nascent and we're helping to establish. To be transparent, there's probably less of a secondary market today, but we do think that will change in 5, 10, 15 years time, albeit we don't really need it to change, if that makes sense.
And in what situation would you just exit the royalties? Is it capital gains perspective you think is a really attractive valuation?
Yeah, I think that's right. I mean, ultimately, we love the assets that we buy. We love the diversification. We love the fact that no single asset will ever be more than 3% of our NAV. And we really want those different uncorrelated revenue streams. And the truth is, if you look at some of the assets in our portfolio, if you were to sell them, you will never be able to get that back because they're really of the highest quality. So it takes a lot for us to sell. And so if the asset is trending at a 14, 15% IRR and somebody offers a 17% IRR, we will obviously take it into our investment committee and discuss it. But the reality is, I think the answer is we won't sell for that price. If you look at the ones we have sold at, they have been marked at 1.5, 2 times greater than the returns we currently see in that asset, at which point it starts to make sense for us to consider divesting. So there really has to be capital gains from it for us to decide to sell.
I think, it's a really clever strategy. I think it sounds really good because you sort of get the equity-like returns with downside protection, right? What are the risks?
People always say it sounds too good to be true. The truth is, at the strategy level, it's not too good to be true, but it works. Because there's no correlation between a healthcare product to how a music investment performs, to how a film investment performs, to how a natural gas investment performs, to a green metals. They're not linked in any way, shape or form, which is why over, as I said, now into our 7th year, we've never had a 5% quarter. Equally, we don't expect to have negative quarters, right? Because some are up, some are down. You put them together, you typically trend in that kind of 1.5% to 3% return for the quarter. It doesn't mean that we don't have underperforming assets. We do. I think sadly we will always do, because you can't get every investment correct. The aim is obviously to learn from your mistakes, minimize the underperformance at the asset level, minimize it at the portfolio level. I would say the 2 biggest risks in royalties: number 1, development risk, so investing too early. And there, if the asset doesn't produce anything, you are making a zero on it, which is why we don't do development assets. We're investing as late as possible. So that really leaves you with 2 main risks. Number 1, the predictability of the revenue that you're forecasting, because ultimately we're exposed to a revenue line. The revenue line is lower, that's less good. The revenue is higher, obviously that's nice. So anything which drives volume and pricing, you have to be able to take a view on. And then the second aspect is really all of the legal aspects. It's the contracts, it's the audit rights, it's the information that you have to monitor your investment, it's the IP, it's the strength of the IP, it's the duration of the IP, it's the chain of title, which is why our asset class at Partners Group is the only one who has dedicated investment lawyers in the investment team, because half of the work is all of the contractual and the legal side that comes with the royalty investing. And you'd be amazed how many people get that wrong. And so that aspect is very important.
And normally it's inflation hedge, right? Because it's top line revenue driven.
Yeah, and you have a double whammy because we don't fund the costs. So if you think about a company who has an asset, if there's inflation, yes, their revenue line is rising, but their cost is also rising. We don't have the cost part, so we just have the revenue line increase. So it's not a 1-for-1 inflation hedge, but we do move positively with inflation, particularly seeing as though we don't typically underwrite it in our forecasting either.
And I guess from an asset allocation perspective, if you were like a CIO, how would you, allocate? What is the ideal optimal percentage?
You're asking the wrong person, because I'm very long royalties.
You're probably biased.
Personally, yeah, I'm very biased. I think it has a role in everybody's portfolios. Obviously, if you're very high returns, hedge fund, octave driven, like 20, 30, 40% IRRs, we shouldn't be a massive percentage of your portfolio, because obviously we're targeting low risk, low returns. But if you want something where you can invest in it, you can kind of sleep on it for 10 years, you come back and it's steadily accreted and it's continued to pay out a yield during that time period, we think royalties has a nice role to play. If you're very focused on income, then I think royalties has a very large role to play, because we're not driven by interest rates. And so putting us with a credit investment where we generate the yield when rates are low, and then when rates are high, credit kind of generates a kicker on top of us, we think that's a nice mix. So in an income-focused fund, we think royalties can play a 10 to 15% role, and then in all other portfolios in that kind of 2.5% to 10% range.
Great, thank you. I think this is really a masterclass about royalties because it's relatively new. I think it's really important to understand the underlying. It's a very smart way of investing, and also I think it's a good tool to be put in the portfolio.